You're listening to the RE Social Podcast with your hosts, Andrew and Vince from AnVi Invest. For more information, go to anviinvest.com.
Hey guys, welcome to another episode of RE Social Podcast. And today we have a super special guest. And if you guys haven't been living under a rock for the last 100 years, you know who he is. It's Mr. Jason Hartman.
Hey, Vincent, it's great to be here and looking forward to talking about some important stuff today to help investors do better with their investments and limit their downside risk. Now is a good time to be limiting risk, that's for sure.
Yeah. Jason, before we start off, can you give like a 90-second background of who you are for people who have been living in a mountain?
Yeah, sure. I'll make it 92 seconds if that's okay. So basically, I grew up poor in Los Angeles, California, didn't like being poor very much. So when I was 16, I saw a infomercial for a real estate guru. I went out and got his book. I read 3 chapters, put it down. And then when I was 18 years old, my mom, for the past 2 years, she picked up that book and she had been studying this stuff and got very interested in it. And there was a big seminar in Anaheim, California. I lived in Long Beach, California at the time. And she said, you know, Jason, you got me into this real estate stuff. Why don't you go to the seminar? And so I did. And I didn't know what they were talking about. I mean, it was just all like a foreign language. So I decided to enroll in real estate school just to get my license to learn the basics of real estate, thinking, you know, agents must know something about real estate. So they know the basics, at least. They understand financing and contracts and things like that. And then I'll just go through that licensing course and then I'll understand what they're talking about so I can be an investor. I never really thought of being a broker, right? I thought of always being an investor. And I got my real estate license my first year of college. I was going to Long Beach City College, not far from where you live. And I started selling real estate part-time for Century 21. And about 6 months into my career, as I was selling mostly HUD and VA foreclosure properties, one of my clients, his name was Jim Wool, he purchased several properties from me, and I, drove people around in my little Volkswagen Jetta and, sold them properties on these government repo, really ugly foreclosure properties. And there was one he bought from me that he didn't like. And he said, hey, why don't you list this property for me and sell it and I'll buy something else from you. And I looked at it and I remember I sold it to him, a few months earlier. And I said, you know what? I don't want to sell it for you. I want to buy it from you. And I bought my first investment property while I was living at home with my mom at age 20. And that's how it all started.
Wow. And then how did you know about investing versus most people live their whole life not knowing investing, even though they're agents? Was that the book? What book was that?
That first book I got at age 16 was Nothing Down by Robert Allen.
Oh, Robert G. Allen. Love that guy.
Yeah. It's funny because now I've met him several times and he's in a mastermind group with me and I told him the whole story. And so, it's amazing how things circle back decades later, right? But yeah, I got that and I started reading a whole bunch of books and going to a whole bunch of seminars and conferences. And I just wanted to learn everything. And, if there's one trait, and I'm sure your listeners have this trait already, so I'm probably not telling them anything they don't know. But if there's one key to success trait, it is being really curious. You got to just be curious about the world or your field or whatever you want to learn. I just wanted to soak up knowledge and learn everything I could. And I've just always been that way. I listen to tons of audiobooks. I read all the time. And I think that's just very important.
You mentioned something very interesting. A lot of people might have missed right now is that you said you go to a bunch of these conferences and, meet people like that. Can you explain to the audiences why that's important? Because that's very difficult for me to explain to people. And, I'm coming to your Scottsdale event. I want to spend a little bit more money so I can get lunches with you, meet Kenny and stuff, because I know the value of that. But can you explain to people why that's important?
One great quote is by the founder of the McDonald's franchise system. We all know the story now because most people saw the movie now, right? And that's Ray Kroc. He's not the founder of McDonald's, that's the McDonald brothers, but he's the founder of the franchise system. And he had this saying, he said, as long as you're green, you're growing. As soon as you're ripe, you start to rot. Okay. So you've always got to be learning. You've always got to be out there. You've always got to be stimulating your mind. And that's why I like going to conferences and being involved in mastermind groups and just being around people who are, really trying to do big things. I have a little addictions like everybody does, but that's definitely one of my addictions, and it's a positive addiction, So, yeah.
Yeah. And then, so just for a little snapshot for people, so you bought that one property when you're 20 years old. What do you have right now? Like a couple of properties, 3 houses?
No, I have about 126 units at the moment. I've had over 600 in my career. I've really been kind of looking to scale down a little bit because, I just like, what am I going to do with all this money? Okay. I just I don't need it. Okay. I want to focus on enjoying life a little bit more and having a little bit less to think about, which I have not been good at, I must admit. So I'm trying to get better at that.
Well, I really enjoy your shows. I like the shows because you don't, it's like straight, like from the heart kind of, like you just say how it is. I really like that style. Do you ever passively invest even with your buddies? I know a bunch of your buddies have so many.
I do, but I don't do as well with that. One of the big parts of my content is called the 10 Commandments of Successful Investing. And commandment number 3 has really resonated with a lot of my listeners and my audience on my podcast and YouTube channel. And that is, thou shalt maintain control. Because whenever you put your money with someone else in a pooled money asset class, you're relinquishing control to them. And you're going to leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook. We're certainly all familiar with all the scandals on Wall Street, all the scandals in crypto, the latest being Sam Bankman-Fried. And, there's just a zillion of these scams, right? And Bernie Madoff and, Goldman Sachs and Merrill Lynch and all the others, right? They're just ripping the world off, these people and these companies. So that's the first problem. The number 2 problem is you might be investing with an idiot, right? So you're going to lose money because of their crookery or their incompetence, right? And then the third problem, assuming they're honest and competent, they take a huge management fee off the top for managing the deal, right? And we're all familiar with the Wall Street executives at all these big companies giving themselves giant pay packages, giant bonuses, as the shareholders are losing money. Right. And that's just totally out of alignment. That's not the way it should be. That really shouldn't be legal, but it is. So I just prefer to be a direct investor, own and control the asset to where I don't have a bunch of people in the middle that can just skim all the profits off the top. Right. But the downfall of that is it comes with a little more responsibility. Right? You've got to think about more stuff. You're managing it yourself or with your direct employees, but the profits are so much higher. The chance of getting burned is just extremely low when it's your thing. You're a direct investor. You own it. You control it. You decide what to rent it for, who to rent it to, when to refinance it, when to do improvements or not, when to sell it. It's just under your control.
So I have a couple of follow-up questions just to, talk about the debate about that, because I know you like, what is it? Debate versus monologue, you say? A dialogue versus monologue, right? So
yeah. Well, that's what I was talking about. An article I wrote about 22 years ago or so, the monologue media versus the dialogue media. And I was just pointing out that the left side of the political aisle, it has always been in control of the monologue media. And with these social media and big tech companies, that's what they're still doing, is a monologue, a one-way conversation, where the dialogue media has always been controlled by the right side of the political aisle. And, that's either AM talk radio, the blogosphere, and social media, if you let it be free, like the new Twitter, maybe. We'll see.
We'll see, yeah.
That's what that was about, yeah.
So my question to follow up to what you were saying is, for example, let's just take you, for example, right? And let's say I'm a doctor and I'm starting up. There is absolutely no chance in hell I'm going to have the same skills as you, Jason Hartman, with 126 units. So it makes no sense for me to start it and figure out the next 5 years to try to be you, because it's not possible, first of all. It will take me a long time. So isn't it better to just partner with you?
So first of all, and no offense to the doctors out there, but this is a cliche. I'm not making this up myself. I've heard it for decades. I mean, you know, there's a saying, doctors are notoriously bad business people, and most of them are just not good at it. There are a few that are great at it, right? Because they're scientists, right? That's a different part of the brain than an entrepreneur. And when you invest in real estate, you are essentially a business person. You're an entrepreneur, okay, in a sense, right? Although it's much less involved than running a company. That's like really a lot of complexity, right, compared to a real estate investment. But, you know, I was having this debate with a good friend of mine a few weeks ago. You know, this game of buying houses and renting them out is a pretty simple business. Okay, it's not very complicated at all. Now, can you go listen to my 1932 podcast episodes and learn more about it? Sure you can. Can you optimize it more? Absolutely. But look, I grew up with my mother who was just buying a few houses and renting them out. She was self-managing them, never had any property managers, you know, never like, it wasn't her first thing. She had a job always, right? It is a relatively simple thing. But of course, if you want to get really good at it, you can optimize it by learning more and doing more, of course. But people should not overcomplicate this. And maybe my whole industry is to blame for making people think that it's too complicated. It's just really not that complicated, okay? I mean, for thousands of years, literally thousands of years, okay? I mean, in ancient Rome, there were landlords, okay? And there were tenants. And, you know, I actually talked about that on a podcast maybe a few months ago, where I talked about how much of your income in ancient Rome could be used to rent a house. And interestingly, the rent to income ratio is about the same as we practice today, about 1/3. Isn't that interesting? Right? And this is just not a complicated thing. There's zillions of mom and pop landlords who never listened to a podcast because they didn't even have podcasts when they did it, okay? Who never read a real estate book, okay? Who just bought some houses and rented them to people. Like, it's not that complicated, folks. Now, of course, you can be better at it, okay? But I just don't want to put up huge barriers for people by like overcomplicating it, right? It's a pretty easy business. It's pretty simple. Buy houses, rent them to people, collect the rent.
And you would recommend, even if the people are very short on time, like they don't have, because they have a full-time job?
My company basically helps people invest in properties nationwide. And we recommend property managers to them. And we also teach and support them in self-management. So they can do it either way. Okay. And the vast majority of our clients use property managers. Now, I've done it both ways, many years. And, you know, I just think overall, the best thing to do is to self-manage your properties. If you're brand new to it, don't do it right away. Have a manager the first year and learn from them, right? And then self-manage if you want to. You can always go back to a manager if you self-manage. You know, any day you're sick of management, you can call a property manager in that market and they will be glad to have your business, okay? So it's not like you're closing the door forever, right? You can just decide at any point. Okay. But you know, you can make a fortune having property managers. Interestingly though, we're getting into kind of a different discussion, right? You know, first it was real estate in general, direct investment or non-direct investment. That's one discussion. Then the next discussion is it difficult or easy, right? And that's a discussion. And now we're talking about, if you buy properties, should you manage them yourself or have a property manager? So that's a different thing, right?
Yeah, I know. We can talk about hours for everything.
Yeah, I know. But just the one thing to say on that is, interestingly, when you don't have a middleman in the middle of the deal between you and your tenant, you don't have someone with a separate agenda. And amazingly, you might spend a lot less time self-managing than you will having a manager.
Wow, that's very interesting.
Oh, hands down. I think self-management's a cinch Now, we recommend a hybrid approach to this. And, this is a whole, I mean, look, you're a member of our Empowered Investor Pro group. And, we have Zoom meetings. We teach people about this. We support them. We have investment counselors that help them. Okay. We have a hybrid approach. So when we say self-manage, you're really using some services, but not all of them. Okay.
Sure.
So there's not enough time to go into that today, but
you
can do it either way, whatever you want. Doesn't matter. You can do it either way. The point is, invest in real estate. It's the most historically proven asset class in the world.
That's true. Actually, funny story. I was actually going on an Uber ride in California, and we started talking about real estate. This guy said, "Hey, do you know this guy named Jason Hartman?"
The Uber driver said that?
Uber. And he said he knows you. I forgot his name, but he said he knows you.
Good stuff.
So that's funny. But
we have probably quite a few Uber and taxi drivers who are listeners because they can listen easily while they're driving around. That's great.
That's pretty funny. But I was going to pivot to the reason I follow your stuff is you talk about interesting things like we talked about like comparing a house to mangoes or like not just using dollars, right? So and then also about You coined this term, inflation-induced debt destruction. Can you?
I'll just share my screen here because I've got a couple slides to show you.
Okay.
I really believe that you got to have some unique approaches to income property investing. And these ideas came out of my own head. All right. One of them that I trademarked years ago is about the way you can really optimize an investment in an inflationary environment. Okay. Now, certainly some of these fragments of these ideas were inspired by other people and other readings and learnings and things like that. But I call this inflation-induced debt destruction. And it is an incredible technique. It's the hidden wealth creator that creates tons of wealth for people with income property, especially. It can be used in other things, but especially with income property. It's got very unique characteristics for it. And, you can check out my YouTube channel or podcast for lots more on that. The thing you also alluded to was an index I created called the Hartman Comparison Index. And what that really involves is measuring the value of real estate. People have a lot of blind spots when they measure the value of anything against only one other thing. And they definitely have these blind spots when it comes to real estate because virtually everybody is measuring it against only one thing, the US dollar. And that can create a lot of mistakes. And so I created this index, the Hartman Comparison Index, or the HCI, to basically compare real estate to a whole bunch of other things. We've got about like 42 things, I think, now in the index. So, you should compare the value of real estate to gold, oil, Bitcoin, rice, the food stock of 2/3 of humanity, all of these other things. And then you can really understand if it's undervalued or overvalued. That's a really important thing to do, and that's why I created the index. And again, we won't go into the index today in a whole bunch because I know we wanted to talk about another strategy of mine called the Hartman Risk Evaluator. Right now is a time when people really, really want to make sure they are minimizing risk. Okay, this is the type of economy where this becomes extremely important. There's an old saying, everybody's a genius in a bull market. Okay. And then there's that other old saying Warren Buffett likes to repeat a lot. He says, when the tide goes out, you can see who's naked, right? Okay. And so that's what we want to do. We want to minimize our risk and protect ourselves on the downside right now. And I think that would be a good thing to talk about today.
Okay. Sounds good.
So going into that, we've got to understand first, there are three major types of markets in the country or in the world. There are linear markets, there are cyclical markets, and there are hybrid markets. So the linear markets are the markets we like to recommend, as you know. These are the markets that kind of just cruise along and do their thing. They have small peaks and valleys, small ups and downs in the market. If you're looking at a chart of appreciation over time, then they look like this, okay? So here is a linear market where we've helped hundreds and hundreds of investors buy in Memphis, Tennessee. I've owned properties here, and It's a very linear market. It's pretty boring. It goes up in price, it goes down in price, it goes up, goes down, but it's relatively muted, right? It's not very significant. It just kind of cruises along. Another one where we've helped hundreds of people buy, I've owned many properties, Indianapolis, Indiana. These are boring linear markets where prices just sort of look pretty straight as they go along the line. Now, here's where I grew up, Los Angeles, California. This is a cyclical market. It looks like a roller coaster. The prices are up, then they're down, then they're up, then they're down. It's just crazy. And cyclical markets versus linear markets, cyclical markets are characterized by one major thing: land value. That's how you know pretty much all the time if you're in a cyclical or a linear market, the value of the land. When people buy a property, they commonly think that they're just buying one thing, but they're really buying two major components. They're buying land and they're buying the improvement or the house sitting on the land. And we need to divide these two or segment these two when we think about them with our properties. So I want to show you some examples here. By the way, before we jump off to that, I want to say a really important thing, and this is back to the Hartman Comparison Index or the risk evaluator we're talking about, is all of life and valuation is about comparison. So always ask the most important question in life, which is compared to what? That is always the question you want to be asking about, like virtually everything. Okay, compared to what? So this is something that it really took me 19 years to kind of discover. What happened here in developing the risk evaluator was this. I was purchasing one of my first out-of-state properties. I lived in Orange County at the time, and I was also buying a home for myself in Orange County. So that home in Orange County was $815,000 at the time. This was, 2003 or so, okay? Then I was also buying a property across the country, and it was $159,000. And I got a call from my insurance agent. Her name was Jennifer, and she worked in Irvine, California. That's where her office was. And that call made me realize something very, very significant, and that's what we're going to talk about. So here it is. Two components: land value and improvement value. So the improvement is the house or the apartment building or whatever sitting on the land, the structure. The land is, as the name would imply, it's just the dirt underneath the property, right? So let's look at the things that impact improvement value, this component here, okay? Factors increasing this improvement value are building restrictions and environmentalism, right? This is one of the issues with California, especially because you've got a very strong environmental lobby. It's very hard to build anything, and that makes the value of improved land higher because you can't build anything on any vacant land very easily, right? Without 36 environmental impact reports and just a huge bunch of cost, okay? Oh, by the way, there's a funny kind of riddle about this. What do you call a developer? Someone who wants to build a house in the woods or at the beach. What do you call an environmentalist? Someone who already has a house in the woods or at the beach. If they've already got theirs, they don't want anyone building anything else, right? And
they so make our home values go up more, right?
Yeah, no question about it. Being restrictive and not letting anybody else in keeps your values higher. That's why it's done. It's fake environmentalism. When I interviewed Thomas Sowell on my show years ago, he's a great author, a great intellectual. He's retired now. He's, I think, like 91 years old. But I coined a term during that interview, and I was referring mostly to Orange County because you have all this dedicated open space, right? And what that really is a form of what I call, and here's the term I coined, environmental racism, okay? And what that is the people get in there, they buy their homes, and they want to keep everybody else out. And, by dedicating a bunch of open space that can't be developed, it makes the price of their properties go up, which keeps people out, right? And so it's really just total hypocrisy, okay? But that's another discussion. Industrialization of developing countries. So the massive development of mostly China and then India after that has created more and more demand for construction materials, especially concrete, right? And so that pushes the price up, the raw materials cost. For example, in 2004, inflation was only 3.3%. Yet in that same exact year, steel and iron prices surged by 34%. Lumber was up 17%. Now, look, during the pandemic that we just went through, we all heard about construction materials prices, right? But when I started talking about this before COVID, nobody thought about it unless you were a builder, okay? Right? This was really new information to a lot of people, okay? Lumber was up 17% in a year where inflation was only 3.3, and prices of wallboard up over 20%. Labor costs increase the value of the improvement component to the property. And of course, energy cost, right? Because it takes energy to build anything. So this is a house that I owned in Orange County, and I sold it in 2011. This house was $815,000 when I bought it, and it went up in value. But here's the tax bill when I bought the house. Because the reason we want to look at the tax bill is because they break down the land cost and the improvement cost. So when I bought it for only $815,000, the tax assessor for Orange County said, you know, the land is worth $660,000. Obviously, I'm rounding off here. Okay, and the building sitting on the land is worth $156,000. Total $815,000, right? So that's the breakdown. How does that look? Land value very high, and as a ratio, improvement value very low. I created a ratio and I gave it a name. I call it the land to improvement ratio, or the LTI ratio. Now, if we've applied for a mortgage, we all know about the loan to value ratio, the LTV. This is the LTI, the land to improvement ratio. And so here's how it broke down. We had 660 land, 81%, 156 house sitting on the land, 19%, for a total of 815, 100%, right? So what happened? Well, that house went up in value, and I got it appraised for a refinance. The appraiser came over. He said, congratulations, Mr. Hartman. Your house is worth $1.3 million. And I thought, wow, that's fantastic. I'm up $485,000. And then a year later, I called him to refinance it again. Okay. And he said, hey, I got the same appraiser came over, by the way. His name was Eric. Okay. The same guy, which is really kind of amazing. The same appraiser came back a year later, and he says, bad news for you this time. It went down in value and it's worth $1,235,000. So I lost some money on it then, right? So the question is, when it went up in value so high, which of the two components went up? Any guesses?
Land, right?
Land, yeah, you're absolutely right. Now, the improvement might have gone up a little bit too if those materials got a lot more expensive, but it's mostly the land. But then when it went down in value a year later, what went down? Where did the money, the loss come from? The improvement or the land?
Land?
Yeah, land. Okay. The land is the thing that really fluctuates. The land has much more volatility than the improvement. So here is the lesson coming up. This is what's important about this and what we can really learn from it. The risk evaluator tells you that if you want to have a lower risk investment, you should gravitate to markets with a high improvement value in comparison to land value, because those are less risky because the land component is smaller. So here's the comparison. I was buying the house in Orange County for $815,000. I was also buying a house across the country for $159,000. Jennifer called me. Remember, she's the insurance broker. And she says, hey, Jason, I got to tell you, I've got insurance figured out for both of these houses for you. On the Orange County house, we're going to give you insurance for $160,000 in improvement value. And on the house across the country out of state, we're going to give you insurance for $135,000 in improvement value. Let's think about this for a minute. We already analyzed the Orange County house for 815, and we know the percentages there. But on the other house, that was 159.9. She said the improvement value was $135,000, meaning subtracting that the land is only worth $24,000. It's a really small component. So if the land value goes down by half, I'm going to lose $12,000 on this one out of state. If the land value goes down by half on the big one, I'm going to lose $550,000. Well, sorry, that's after it went up, okay? And it did go down later, by the way, okay? But at the time, if the land is valued at $660, I'm going to lose $330,000, right? If it goes to half in either case. Sure. The improvement value fluctuates a lot less because all of those building materials, the copper wire, the glass, the steel, the concrete, the petroleum products, the insulation on the copper wire, right? All the energy that it takes to build the house, all of the stuff around us now, right? You know, the ceiling above me, the floor below me, the walls behind me, right? Those materials are traded globally. They're not attached to any one currency, and they're needed literally by every human on Earth because every human needs food, clothing, and shelter, right? So those things are a lot less volatile than land. Land becomes very speculative and it goes up and down a lot. All cyclical markets have high land values. All linear markets have low land values. That's the list.
That's very interesting.
Yeah.
You know, I had a very nerdy question to follow up with this. So does this change your depreciation cycle schedule?
That's a great question. I'm so glad you asked. So the IRS basically says that you can depreciate the improvement component because the land will always be there. So it will always have value. But someday the house will fall to the ground and have no value at all. It will decay, right? So the IRS, through lobbyists in Congress and all of this stuff, right, and paying off politicians, they've somehow decided that the depreciation schedule for single-family homes should be 27.5 years. Has nothing to do with how fast a house really depreciates. And it could be a used house and that's still the schedule, or it could be a new house and it's still the same number, right? It has nothing to do with it, right? But 27.5 years. So if the improvement value, let's do the example, right? Say that my Orange County house, and I'm pulling out my calculator right now. Say that my Orange County house was a rental property. What was the land value on that? It was $156, right? Or the improvement value. $156,000 divided by 27.5 years. 27.5 equals, that means my depreciation on that one is going to be $5,700 a year. That's my deduction if I qualify for the depreciation, which is a long discussion we don't have time to go into now. Check with your accountant, but make sure you ask your accountant about the possibility of becoming a real estate professional. Nothing to do with selling real estate necessarily. It's a professional investor designation. Okay, the house out of state, right? What was the improvement value there according to Jennifer, the insurance agent?
135, I think.
135,000. Not much different than the much more expensive house in Orange County, right? Almost the same. So now we'll take $135,000 and we will divide it by 27.5 years, and we get $3,700 a year. Okay, so amazing that you can buy a much less expensive property and still have the opportunity to get a very large tax write-off because that improvement value is almost as high as the improvement value in Orange County, which is amazing. And the risk is much lower. If you are a speculator, if you are a gambler, then you should buy properties in cyclical markets. I wouldn't recommend it. I don't think that's a good idea. But if you are an investor and you think long-term and you follow my definition of investing, which is the legitimate process of creating value over time, and you know if it's an investment, if it produces income. If it doesn't produce income, it's not an investment. It's a speculation or a gamble. Okay, so non-dividend paying stocks, speculation or gamble. Cryptocurrency, speculation or gamble. Precious metals, speculation, gambling, right? The whole strategy is buy low, sell high, that's it. Okay, Dividend paying stocks, okay, buy low, sell high, collect some income along the line, some dividends, right? Income property, multidimensional, best asset class in world history. Buy low, sell high, get income, get tax benefits, use leverage, get inflation-induced debt destruction. It's the most beautiful asset ever, right? Nothing beats it. So hopefully this risk evaluator thing really helps people, because now is a time where you really have to mitigate risk and be very careful. You want to buy properties with low land value, with good LTI ratios, land to improvement ratios. That's the key to reducing risk on the downside, because those high improvement values and low land values set a floor as to how much the property could go down in value. And you know what? This is playing out exactly as I predicted right now as we speak, because the markets that are cyclical are suffering the most. The West Coast of the United States, the expensive Northeastern markets, Boston, New York City, Washington, D.C., these markets are seeing a lot of pain. Miami, which is just south of me, I live in South Florida in Palm Beach, interestingly, isn't seeing much peril yet, although that is a cyclical market, believe me, okay? And if things continue to deteriorate, even Miami will be hit. It's only gone down a little bit so far, but Florida has kind of a special get out of jail card because of its very business friendly policies and what most people think is a great governor. I like him, but some people don't. Florida's done a lot of very smart things in, much less restrictive states. So, it's getting a lot of inbound migration. So it's a little different, even though it's a cyclical market. Miami's definitely cyclical. South Florida's cyclical, no question. Okay.
Yeah. A lot of good points, Jason. I'd like to close out, I know we're coming to an end. A lot of the people who listen to the podcast here, they're always trying to buy the next property or the first property. They're always scared, right? So for them, the advice, let's say they're living in California or close to me or in New York City, you would definitely, if they want to participate in this activity, should we wait a little bit for them, or do they go into a less cyclical, less land value in a market right now?
What are you saying? Should they wait to buy or invest, or
Yes.
what's the question? Okay.
Yeah. Should they wait to, because we know it's going down, right?
Yeah. Well, that's debatable. Okay. But it doesn't really matter.
We know it has gone down.
Yeah. Look, folks,
on the peak.
There's a giant misnomer here. Okay. The whole world just doesn't get it. Okay. And I'm just going to lay it on the line here. Okay. If you are an investor, okay, you don't worry so much about the value of the property, because you invest for yield. You invest for income. That's investing. Speculating is worrying about the value, right? You're going to buy these properties and you're going to hold them for a long time. And everybody who has done that, unless they invested in Detroit, has won the game. Everybody who has tried to time the market has pretty much lost the game if they tried to time the market over a decade. If they got lucky and timed it on the short term, and, look, I'd rather be lucky than good any day, but you can't guarantee luck. So you got to try and be good, right? But, if you bought in Los Angeles in, 2020 or, 2002 or whatever, right? Or 2010, right? The values went up a whole bunch, right? That's a cyclical market. So it has fast increases and quick falls. But if you bought in these linear markets, it's got little minor ups and downs. It's just not that significant. And you're getting good cash flow all the way along. The other thing a cyclical market is characterized by, besides high land values? Terrible cash flow. And another thing they're always characterized by, almost always, landlord unfriendly. Okay? And very tenant friendly. So those are some of the things to look out for.
Unfortunately, my entire portfolio is in California.
Yeah. Hey, listen, I used to be there too. Okay. I'll tell you something else. You've got to remember that even if the properties go down in value, right? If you buy good linear properties that make sense, they've got good income, they've got good numbers, and they're in linear markets. Even if those go down in value, compared to what? That's the most important question in life compared to what? So what else are you going to do? What are your other options? Okay, you could keep your money in the bank and you will be guaranteed to lose 9% per year. And that's only based on the official inflation rate. The real inflation rate's probably 15 to 17%. So you're going to lose that much by inflation destroying the value of your savings. If you put it in precious metals, I don't know what's going to happen, but you're certainly not going to get any income. It might go up. Nobody knows. Okay. If you put it in cryptocurrency, nobody knows. Speculative asset again. If you put it in stocks, I don't think the stock market's going to do very well for quite a while. Okay. Well, we'll see. But, it's always about the alternative. Too many people are focused on the investment rather than asking themselves the broad question of, well, what are my choices? All we can do as economic actors and investors is make the best available choice. No choice is ever perfect. Okay. There's an acronym that is commonly used in the world of economics and investing. TINA. There is no alternative. TINA. There is no alternative. So look, pick the best thing you can do. Right. And I say income property is far and away the best thing. Like nothing's even close to it at this time. Right. Good income properties that make sense in good linear markets. It's going to be the best performing asset class.
And you will still recommend people go with the 1 to 4 single family to a 5+ unit?
It's my absolutely favorite. It's got the best financing. It's got the shortest depreciation schedule for the best tax write-off. And it is the most in-demand asset class that has the biggest shortage. Entry-level single-family homes in linear markets are in massively short supply. I mean, just the shortage is terrible. Okay. Now,
they don't even build them for entry levels.
No, they haven't been building them for 14 years, really was the last time we built any significant amount of entry-level homes in this country. Okay. Yeah. So look, when people look at real estate statistics, they're looking at the whole country usually, first of all, which includes every market in every price range. So when they hear on the news or read an article, oh, home builders are suffering because, they're cutting prices and slashing prices and people are canceling contracts. The vast majority of those homes they're talking about, they average about $600,000. We're not recommending you buy that. We want you to buy $250,000 to $350,000 properties. Okay? Cheap entry-level housing, necessity housing. When the economy gets bad, people go to the necessity. They don't go to the luxury. The luxury isn't available anymore to them. They can't afford it, but they got to have some place to live. So good, solid entry-level houses in linear markets. That's the thing to invest in. Those are not the statistics you're hearing on the news or reading anywhere. Okay. You're hearing the broad numbers. It's the whole market.
Yeah.
That includes $5 million homes and $1 million homes and mostly $600,000 homes, right? That's most of what you're hearing about.
Mm-hmm. That's true. Thanks, Jason, for coming on the podcast. And if people want to get a hold of you, where they should find you, and then do you want to tell them about the event in January? I'll release this episode before that.
Yeah, thanks a lot. My main website is just my name, jasonhartman.com. That's Jason and then HARTMAN.com. Of course, you can find my podcast on anywhere you get your podcast. Just look up Jason Hartman, and my YouTube channel, same thing. And our event in January is called Empowered Investor Live. It's in beautiful Scottsdale, Arizona, last weekend of January. And you can get tickets for that at jasonhartman.com. Our events, by the way, are super fun and very educational. We've got some great speakers. Sharon Lechter, who's written a zillion books in the Rich Dad series and a whole bunch of other great books. So Sharon Lechter is speaking. George Gammon is speaking. Ken McElroy is speaking. We just got a great lineup of awesome speakers.
Tom Wheelwright.
Yeah, Tom Wheelwright, Joe Brown with Heresy Financial. We've even got probably one more really big name speaker we're going to announce. But then we've got all of our local market specialists that have properties, and we've got people with more like specific technical education. I'm speaking, of course. So it's just a great event. We got cocktail reception Friday night. It's 2.5 days. Friday night, cocktail reception. Saturday night, we're going to have a band dancing. We'll have a lot of fun. It's just a great event. So the people that come to our events say that they are the funnest thing they've done all year. Okay. Like I hear that all the time, especially after they're done dancing the night away with the band and all that stuff. So it'll be a great time.
That's cool. Thanks, Jason. Thanks for
all right. Happy investing to everybody. Thanks, Vincent.
Yeah. Thank you.